Netflix is officially the 18th largest company in the entire world with a market cap of about $556 billion, which can be contributed to the huge rise in stock price over the past 3 years, with Netflix stock up almost 630% just in the past 3 years, going from about $150 per share to at a stock price of $1,300 as of today. And Netflix has shown to us investors that they are the top streaming company, outperforming basically every other streaming service, especially Disney, Paramount, and all these other streaming services, in which Netflix has really shown that they are the streaming company. And as we can see here, as a result of the huge decline in stock price in 2022 was because of the worry about the Netflix business. And if we look at the subscribers in 2022, there is actually a decrease in subscribers. But besides that, we can see huge increases in subscribers. And in 2024, they added still over 20 million subscribers. And that is more than 2021. And this has still been a very large growing business. And this could also be because of the changes in subscriptions. Netflix has added a new subscription over the past few years of a standard version that has ads, which helps people that can potentially want to buy this service and actually buy it at a cheaper price, which could actually help Netflix by advertising other businesses in which they make money from the subscription and also from ads paying them to be able to be advertised on Netflix. And also you have the standard version and the premium version where you can actually get unlimited ad-free movies, TV shows, and mobile games, which they have recently added to Netflix mobile games. Then you can also watch it on 4 supported devices, in which Netflix has actually cracked down on the password sharing, which has probably helped the revenue and stock price also by a lot. So if we go ahead and take a look at the top 10 most watched movies on Netflix, we can see Red Notice, Carry On, Don't Look Up, Adam Project, Back in Action, The Gray Man, all these other movies that have been the most watched on Netflix. And then also if we take a look at the most watched Netflix shows, a few really stand out here for Netflix. Especially as we can see here, which really stands out is Squid Game, which helped Netflix generate so much revenue. Also Stranger Things, Dahmer, Wednesday, all these other series that Netflix has made a huge amount of money for Netflix and has helped them make more money and have people stay on the subscription for Netflix. As long as Netflix can continue to create more series and movies that are up to par and the customers like, they're going to continue to make more money. And if they increase the subscription price, then they're going to even make even more money and have a larger net profit margin. So if they can continue to make these quality series and movies, I do think Netflix can continue to grow at a very fast rate. And as we can see, Netflix is also actively expanding into live sports, where they're going to be actually broadcasting a few NFL games with the Christmas games and WWE events. They're also involved with the other sports like the PGA Tour and live golf, and also Formula One, Formula One is a pretty fast growing sport, so I think that could really help Netflix out. So with that being said, for Netflix, I'm going to be looking at some financials of the company and determining the financial health of this company. I'm going to be looking at a few things such as the PE ratio, which shows the valuation of the stock compared to their earnings. Then I'm going to be looking at the revenue, net income, which is a big part of the business, and then looking at shares outstanding and debt to equity ratio, which will help us see the amount of debt that Netflix has. The first thing I'm going to be looking at is the PE ratio, and as we can see, they have a PE ratio of about 60, which means you're paying $60 for $1 of earnings from Netflix. When compared to the S&P 500, which is the entire stock market basically, that is almost 3 times at what the stock market is trading at. So we can see that Netflix's valuation is 3 times the stock market, so it is looking overvalued in that sense, but it doesn't mean that the company is overvalued and you shouldn't buy just because it's trading at a higher valuation. It probably means it is a higher quality company, so that is honestly not bad for Netflix. Obviously, we would like to see it lower since you want to pay less for each earnings for the company, but it's still not terrible compared to some other companies. And if we a look at Netflix's PE over the past few years, we can see that it's actually been decreasing since this time in about the 2010s, but that's when they were barely profitable. And as they've matured at a company, they're trading at a pretty high PE ratio. The last time they trade at this PE ratio was in 2021, so they're at a very high premium over the past 5 years. They're at one of the highest premium valuations you'd be paying today. So it is slightly worrying in that sense, but once again, it's not a deal breaker where you say you shouldn't buy the stock. And later in the video, we're going to be using an intrinsic value calculator to determine the exact price I'd be willing to pay for Netflix. But if we go ahead and take a look at the revenue growth rate of Netflix, which is the sales of the company and how much money they generate. So it's not what they take in, but it's the total amount of money that Netflix has generated as a company. So look at this graph. This is the perfect graph I'd like to see for companies. All of this green and just pretty steady going up. I love to see this in companies. It's very consistently increasing at a pretty good rate. And as we can see, in 2010, they only had $1.7 billion in revenue. And as of 2025, they have over $40 billion in revenue. Just insane growth. And as we can see, it's been growing every year at a pretty good rate. But as we can see, though, it has decreased just because the company's getting bigger and there's not going to be as many people that are going to be subscribing to Netflix, since already a bunch of people are subscribed. But as of 2024 and 2025, they're still growing at mid double digits. So it's still very fast growth, especially compared to some other companies like Apple, Google. Those companies are actually growing at a slower rate. So Netflix is still growing at a pretty fair rate. If we take a look at the net income, this is how much money they are bringing in at the end of the day. So this is the money they keep as a company after taxes, expenses, and all that stuff. And as we can see here, once again with the revenue, they've been increasing their earnings very fast. But as we can see, from 2010 to about 2017, it was pretty stagnant in their net income. But since then, we've seen a huge explosion in net income growth, and it looks very good. Going from just $120 million in 2010 to almost $10 billion in net income for Netflix. And as we can see, this huge growth from 2023 to 2025 is most likely why the stock is rising so much. And here's a secret that people don't want to tell you. If we look at this and we looked at the stock price, and actually I'm going to be putting a graph of the stock price over this, I guarantee you it's going to look basically the exact same. If the company's net income grows over time, and as long as their valuation is pretty fair, it's going to match the amount of net income that they get, just because it's going to be the amount of money an investor gets. So it's going to match the amount of net income that the company generates. So that's a secret for y'all if you want to see what companies you should buy. But once again, past performance doesn't mean future performance, but it is still a good thing to look at just to see the financial health of the company. Now for the shares outstanding, which also contributes to the earnings per share that we will get as investors. If it goes down, that means we are going to get more earnings per share since there's less shares outstanding for others to have. Also, we will be owning more of the company if they buy back shares. Just because there's less shares outstanding, and if you don't change your shares at all, that means you'll actually own a greater percentage of the company. And as we can see here, what I like with Netflix, they've actually been buying back shares, especially from that recent dip in 2021. They bought back some shares. Looking at this, I'm not a huge fan of the buybacks in, say, 2024, because that slightly worries me just a bit, because I do think Netflix could be overvalued at these prices. But once again, at least they are buying back shares and increasing our shareholder value. So that is a good thing, but I would like to see them buying back more when the stock tanked in 2022, because you want to see your company buying back shares at lower valuations. Like we are trying to buy stocks at low valuations to get a greater return. But once again, at least they are buying back shares and not diluting us shareholders. Now I'm going to take a look at the balance sheet of Netflix. Like us, we don't want to have a lot of debt. We want to be in a good financial situation where we don't have a chance to go bankrupt or anything like that, which is the exact same with a company. So we want to see low debt compared to their equity, and we want it to be less than 50%. If it's less than 50%, the total debt to equity ratio, that means that they would have over double the amount of equity compared to their debt. So we want to see a less than 50% total debt to equity ratio. However, with Netflix, we can see that they actually have a 72.51% total debt to equity ratio. While that is not less than 50%, at least it is under 100%, because if it's over 100%, you got to be worried about the company. That means they have more debt than their equity, so that is a pretty bad balance sheet if you see that. But I'm not too worried about this because if you look at the total cash, they have about $8.4 billion in cash and $17.4 billion in debt. So the net debt is actually only $9 billion, which isn't terrible. And as we saw with the net income, in 1 year they made $9 billion. So in basically 1 year, they could pay off all their debt if they really wanted to with all their net income and their cash. So they're not in a terrible debt situation, which is good for Netflix. But it's not amazing. But once again, it's still a pretty good situation to be in for Netflix. Finally, I'm going to take a look at the earnings and revenue growth forecasts by analysts for Netflix. And as we can see here, analysts are expecting their earnings and revenue to grow at a pretty decent rate. We can see that in 2027, they're expected to have revenue of $55 billion and earnings of almost $16 billion. If you compare those forecasts to today, we can see that they have revenue as of today at $40 billion and earnings at $9 billion. So basically, they're showing about a 50% increase in earnings, and they're also showing about a 35% increase in revenue in that time. But if we take a look here, the analysts expect them to grow at about 10% annually for Netflix, their revenue, and a 15.7% annual earnings growth rate. So they're expected to grow their earnings faster than revenue, which makes sense. Most companies do grow their earnings faster than revenue just because net profit margins will likely increase as you mature and buybacks will probably happen. So that will increase the earnings much faster than the revenue. So that looks pretty good for Netflix. Now, the final thing that I'm going to do for Netflix is use an intrinsic value calculator, which uses assumptions of the future to determine what price I'd be willing to pay for Netflix stock. So the first thing I'm going to look at is the revenue growth rate. Analysts earlier expected Netflix to grow at about a 10% rate. So I think that's actually pretty close to what they will do. So I'm thinking 8 to 10%, but I'll keep it at 10% because I do think that's a reasonable growth rate for Netflix. Net profit margin. As we can see, they've been increasing their net profit margin basically every year. So right now they're at about a 23% net profit margin. In the past 10 years, they were at 11% on average. So they've been increasing pretty fast in their net profit margin. So I'm thinking to leave this at 30%. I think that's pretty fair. But I do think this actually could be higher than 30%, but I want to be slightly conservative here for the net profit margin. Just because Netflix is a subscription-based model and they don't really have a lot of expenses to pay. So I do think that 30% could be slightly low, but I am just going to leave it there for now. Now the cash conversion rate, we leave that at 100%. Terminal PE ratio. I think the terminal PE ratio for Netflix could actually be 25 to 30. So I'm going to split that in the middle about and put a 27. Since the stock market trades at about 20 to 25, and I do think Netflix is a much better company than the total stock market, I think they deserve a slight premium and they actually have a pretty good competitive advantage. And now for the discount rate, I'm going to put 15%. Just because I want to make about a 15% year over year annual return on my investment, and I want to actually also have a margin of safety in case we're wrong on some of these assumptions. So with this, I have a fair value price for Netflix at about $700. And I believe if it got to 700, you would make about 15%. But if you bought this today at 1300, I think you could make about a 7% return with these assumptions. But let's say we put the net profit margin higher than what I thought, 35% net profit margin, and say they actually do outperform and have revenue growth of 12%. And with that terminal PE ratio of 27, I do think that you can make about 11% if you bought it today at 1300, and I have a fair value of about $950. So I would be actually looking at Netflix stock. If it got back down to say $750 to $800, I would start to do much more research on this company to potentially invest some money into this company. So thank you guys for watching this video. Please hit the like button, subscribe, comment down below some stocks you want me to analyze next, and thank you.